So like I said, this is Josh Nelson and Jeremy Busch, Keystone Financial. You can see us here on the webcam. We'll take ourselves off here in a little bit, but it's always more fun if we can communicate with you directly. So definitely make sure that you have the ability to not only see us, but hear us, and make sure that you're asking questions and giving us comments along the way if need be. I can see a couple coming through already, so that's great. If there's anything else that comes up along the way, certainly communicate that to us, and the recorded version of this will be available a bit later. So I'm going to start out today. Jeremy is going to jump in the middle, and then I'll finish up at the end. Really, there's been a ton of volatility in the markets this year, but as we go through the presentation, we'll put it into perspective so you can see not just what's being reported on a day-to-day basis by the media, but also just looking at some data, looking at some history that gives us more perspective. So again, I'm Josh Nelson, and I'm the Senior Advisor and the Certified Financial Planner, Founder, CEO. I have lots of job titles and things that could be on my card, but I'm just excited to be here. This is one of my favorite presentations to give throughout the year. We gave this live here a couple of weeks ago here in Loveland, and we always do a webinar version because we know that there are a lot of clients that, first of all, they may not be able to physically make it because of schedule. Second of all, because the availability of room sometimes doesn't actually work out for people with their logistics. And also we just have clients running all over the place, living other places throughout the country, and they might just be traveling and they want to dial in either live or on the recorded version. So we do want to make sure that there's lots and lots of ways that we're communicating with you. Mr. Busch.
Absolutely, and I'm Jeremy Busch, and as you can see there, just realized my title has actually changed since last time we built this. I'm now officially a wealth advisor here with Keystone, so just keep doing things. Thank you very much. But kind of we wanted to reiterate, just like Josh was saying, we know that you're inundated all the time with things from the media, people talking about things like inverted yield curves and all these indicators and things that are pointing to doom and gloom. And so we want to be able to address that. We'll do our best to tackle as many of those items as we can, put them all into kind of perspective for you, just so you can see those things and kind of understand what you should be paying attention to and maybe what you can disregard a little bit.
All right, very good. Well, let's get started. We're going to take ourselves off the webcam here while we go, and we'll jump on here at the end for Q&A. But that doesn't mean we can't, that we're not here. You can still hear us, of course, and we'll communicate with you along the way. So that being said, let's jump in. The lawyers wrote some stuff that you should read really quickly. So
speed read.
Go ahead. All right, done. Next slide is the agenda. We always have the same agenda. For those of you who have been on these webinars before, we always have the same agenda for our halftime event as well as our forecast event. And that is where we've been, where we are, and where we may be going. Of course, nobody really knows where we're going, or we all would be stupidly rich, right? So we're just going to look at the data, look at the landscape that we're in, and really have some thoughtful discussion about the issues that really people should be paying attention to and how that could impact all of our money. But first, of course, we want to warm up. And the first thing we're going to do actually talk about some misconceptions. And a misconception is common knowledge that has no basis in reality. And the way that this was, this is a very scientific study. It was done by Google Hits, right? So you can actually go out and Google Analytics and find stuff like this. But the first one, we'll see who can tell us which one has been Googled the most. And these are all false, by the way. These are all misconceptions. But which one was Googled the most? Sharks don't get cancer, Vikings wore helmets with horns, and Napoleon was short.
I remember from school, I think, I don't know if I say school, but I probably didn't learn it in school. I probably heard it from some kid at a locker, I'm sure. But of all of those, I think my biggest one that I think of was the sharks don't get cancer. And where that came from. But.
Survey says it was Napoleon, the misconception that Napoleon was short. The reality is back in the day, he was 5'7", but that was actually really tall back then for his time. They probably didn't have the same level of nutrition that we do now. So he was 5'7", but tall for his time. Let's try another one. Misconception most widespread. Again, this is based on Google searches. These are all false, but tell us which one or think about which one, since you're not here in front of us, think about which one was Googled the most. Don't swim after eating a meal. I remember that one. I think my parents told me that. Bats are blind. And yeah, I know they're not completely blind, and then caffeine dehydrates you. And I've got to tell you, when we were preparing these slides, that one surprised me. I thought that was actually true. So which one was searched for the most?
I know my mom, my grandma, so many when I was growing up, don't swim after eating. Wait that hour, right? Never failed.
And survey says, don't swim after eating. And it's actually okay, according to David McCandless and informationisbeautiful.net. Don't swim after eating. It's okay as long as you didn't drink, and that would be alcohol, drinking with your meal. Probably not a great idea if you've been drinking to jump in the water. So, and then let's do one more here. Which misconception is most widespread? It takes 7 years to digest gum. Adding salt to water makes it boil more quickly. And again, I'm guilty on that one. I actually believed that until recently. And Salieri hated Mozart.
Yeah, that one's a toss-up for me between the digesting gum and the salt. I'll admit, I still add salt to my water. Makes me feel better about cooking.
Yeah, exactly. That could take some time for me to get over that one. But the most Googled is the adding salt to water. I think a lot of people believe that, but the reality is it may just make us feel better, but it doesn't actually make the water boil any faster. There's no scientific proof that helps. Which misconception is most widespread? Bulls hate red, the 5-second rule, or goldfish have 3-second memory spans. Again, all these are false. Which one was Googled the most?
Oof. I got to go with the 5-second rule on that one.
Jeremy's right.
I got 3 kids and we still use that.
Yeah, that one. I think we just do that out of convenience and probably saving some money, right?
Absolutely.
But it just makes us feel better. But the reality is, it's actually the cleanliness of the floor, not the time on the floor. So that being said, let's jump into where we have been. And it's been a wild ride. When you think back 10 years ago, over the last decade, think about what was going on 10 years ago. And I remember being in this industry, it was the financial crisis. Kind of hard to forget, unless you're really young and didn't have money and were paying attention to the markets. You probably remember this. You probably remember how far your statement went down, if nothing else, right? And it's certainly a time period there where the financial markets were not only extremely volatile, but even at some point, there was about a 3-week period of time in the fall of 2008 where the financial system, our financial system in the U.S., was very close to collapse. So a very scary time. Certainly when you look over the last 100 years, that will definitely be one that stands out as one of the scariest market times. But the reality is, coming off of that period, the market has recovered substantially. And that should be said not only because everything's been rosy, but if you look at every single year from 2009 until the present, I don't think there was a single year where we didn't have negative news, negative market news. We didn't have pundits or even economists saying that we were going into a recession or things were going to crash. Those predictions were still there during the entire 10 years, yet the market has gone up substantially. It tracks the S&P 500 on here. And if you look at June of 2009, when we prepared the presentation 10 years ago, it would have been June 2009. S&P was in the 900s, and now you can see up in the 3,000 range. So a substantial gain. Had you participated in that market gain, and a lot of you did, and I did as well, we definitely enjoyed a climb, even though there was volatility throughout that entire climb. So 2009, again, we were in the financial crisis, very high unemployment rate. I know some of you will debate that 9.5% number, and you're actually right. If you say, well, it was much higher than that, if you factor in people who were underemployed, maybe where they had a college degree, but they were working at McDonald's or something like that, right? Certainly a lot of situations where people weren't getting full-time hours, or they were working in a job that was well less than what their career path normally would have been in. But nonetheless, down substantially. Now we're down to 50-year plus lows in the unemployment rate, down to 3.6%, really almost unheard of. I remember back in the late 90s, this tells you how long I've been a financial advisor, in the late 90s, they considered full employment to be up between 5 and 6%, meaning that full employment means that just about everybody who wants a job has one, and now we're down to 3.6. So that's some huge fuel, and as we go throughout the presentation here, that's one thing to keep in mind. Regardless of negative headlines that you see out there, the consumer is very strong right now, and that because we've all pretty much got jobs, we've all got income, and 70% of the economy is consumer spending. So the consumer is very strong right now, and that's one really, really nice tailwind that we've got going. So employment certainly has gone up. People are back to work, and certainly in the age 65 group, sometimes because people didn't have the finances to be able to retire at 65, but a lot of people are just choosing to work because they're healthier and they're enjoying their work. I'm finding more and more that people are going beyond age 65 just because they want to. Average income certainly has gone up. Not a lot for the average income for the poor, some increase, but certainly average incomes have been going up overall. Home ownership is down, and the interesting thing there is that you look back to what was happening in the financial crisis, much of that was caused by housing, and a lot of people that owned homes that were going through foreclosure still even in 2009. So numbers are certainly down. The other factor to keep in mind too is that for the younger end of the age curve, you think about it, a lot of people are taking longer to get through college, taking longer to get married, taking longer to buy homes. So that's one factor that plays into this as well. And then of course we know home prices overall have gone up substantially over that 10-year period. Now, looking at this year, we've seen a lot of volatility, again, lots of ups and downs, but really overall, if you look at Q1, Q1 was pretty strong overall. Q2 has been kind of a mixed bag, but really overall for the year, it's been kind of hard not to make money. Basically, you could have put money into just about anything, whether it be real estate, stocks, bonds, pretty much everything has gone up. Commodities probably are the one black mark right now. If you look at what's done poorly recently, especially has been commodities. But typically people don't have a large amount of their portfolio exposed to just that index. It typically would be a very small portion that you would see. So overall, not been a bad year. Certainly most people are at gains overall if you've been a diversified investor. And of course, if you're with us, you're diversified and have assets in multiple asset classes. More than likely, you have a little bit of every one of these. So looking at bond yields, one thing that we were dealing with last year is that we were dealing with the fourth quarter in that the Fed had some statements. They had some statements that really spooked to the markets in that the Fed has been raising rates over the last couple of years. And they've been doing that basically because the economy has been healthy enough to start raising rates off of zero, right? We stayed at zero for a long, long time. And the goal of the Fed was to try to stimulate the economy, stimulate employment. And to some degree that worked. I think there are other arguments that economists would make that it wasn't just the Fed. There were other factors that came into play over that decade. But overall, the Fed had started raising rates. And some economists were seeing signs that the economy was starting to flatten out. And then the Fed chairman actually in late November made a statement that indicated the Fed was going to continue aggressively, possibly in 2019, continuing to raise rates. That really spooked the markets, and the stocks dropped about 20% just in the fourth quarter. So a lot of the gains that we had seen in 2018 got erased, and even some losses depending on what areas you were invested in. So 2018 didn't end up being a great year for stocks, largely was because of the Fed statement. Overall, rates had been going up, and now we've really seen rates turn around and drop dramatically so far for the year. You might know that there's actually an inverse relationship between bond prices and interest rates. So that means that anybody who owned bonds, your bonds probably did really poorly the last few years as rates were going up. Your bonds have done great this year because they probably have gone up in value as interest rates have gone down. It's also nice for anybody borrowing money, of course, if you're the government, if you're a consumer, if you're buying a house. It makes it a lot easier to buy a house when you've got lower interest rates. So there's been quite a refinancing boom. Talking to a couple of mortgage professionals that I know, they're very, very busy right now. And a lot of people are asking the question, should I refinance some of my debt, or maybe should I even just finance something that I could have paid cash for? Sometimes people are financing vehicles that just have a really, really low interest rate because they think they'll do better with leaving the money in their investments. The yield curve has inverted, and we'll talk about this a little bit because it's been in the financial news. You might have heard some statistics indicating that the last so many recessions, I can't remember, I think it's the last 5 recessions, have been predicted by an inversion in the yield curve. Well, what's an inverted yield curve? That sounds kind of crazy. What it is essentially is it means that normally, let's say if we borrowed money from each other, if I borrowed money from Jeremy here for a week, he might not even charge me any interest, right? He might just say, well, pay me back. Well, if I said, Jeremy, I want to borrow money for 5 years, he might say yes, and that would be good, right? He'd say yes, but he probably would say, well, we probably should work something out here. You probably should pay me some interest now because you're basically using my money for that 5-year period. And so there's a tendency, a normal yield curve means that the longer you borrow money, the more interest there is, right? And so a 30-year bond, you would see a higher interest rate than a 1-month bond. If you owned that bond, if you were lending your money, say to the government or to another investor, then if you're a bond holder, it means you've lended your money. They should be paying you a higher interest rate the longer the maturity. So a yield curve inversion means that it's just the opposite. It kind of doesn't make sense. In other words, the fact that longer term rates could be actually lower than short term rates. What that's indicating is some stress. What it tends to lead us to believe is that there's a lot of concerns from investors that the economy could be shaky and could be moving lower in the future, and that's what that yield curve inversion can be pointing towards. Now, that doesn't necessarily mean that investors are right, and that's important to recognize here is that just because the yield curve inverts, that does not mean necessarily that we're going to have a recession. It just means that the last 5 recessions, there has been a yield curve before it. There have been plenty of yield curve inversions where there is no recession afterwards. So it's really, really important because sometimes the financial media is not reporting that correctly. They're making it sound like, well, we have to have a recession right now because the yield curve has inverted.
Yeah, I'd like to add on to that too, is the fact that that's one of those, that's one of the indicators anyway, that you hear a lot of. I know the media likes to jump on that one a lot. And they'll throw it out there and they kind of use it as, hey, this is fact every single time that we've had a recession. There's been an inverted yield curve going. And it's one of those statistics that's really overused and not 100% true. The fact is, like Josh was saying, yes, every recession that we've had prior to this has had an inverted yield curve. Is that indicative? Could be. Is it definitive? Definitely not. There have been a ton of times where yield curves have happened and there's been no recession that has followed it. So just, I guess, kind of a word of warning. Whenever you do hear that in the media, yeah, they're trying to make a point and yeah, they do have some ground to stand on, but I wouldn't say that it's going to be a definitive answer there. So I guess kind of take that one with a grain of salt.
Yeah, but one thing to think about too, as far as risks, is the consumer right now spending is pretty high. So that's a factor that leads to a lot of strength. But you might kind of lead to the conclusion with the inverted yield curve and investors thinking that things are going to go down. Sometimes people ask, well, could that be a self-fulfilling prophecy? Could these predictions actually cause consumers to just get scared and stop spending money? Start hoarding cash and building up their savings accounts and paying down their debt, which you say, well, that's probably a good thing, right? Well, yeah, it's good for you as an individual, right, to be more financially stable, but it's not good for the economy. The economy is actually fueled largely by consumer spending. So if consumers pulled way back, and a good example is actually the financial crisis, you might note some of the companies that struggled during that time were car companies, right? GM and Chrysler went broke. They went broke within a matter of months after the financial markets plummeted because everybody stopped buying cars, right? And I guess most companies probably would have that happen. If you've got a product and everybody stops buying it, then you're going to be in trouble pretty quickly. So that's exactly what happened there. And there's a possibility that would happen. Right now, we're not seeing it. We're not seeing consumers pull back at all on spending. So that actually does make us feel good as far as GDP growth in the future. So the other piece of it too is looking at things like this, and especially when there's just individual factors that are at play where somebody says, well, the yield curve inverted, that means we need to get out of the market. You'll notice here that it doesn't take many days of missed performance in the market before your returns get really, really bad. And you look over the last 20 years or so here in the S&P 500. So had you stayed fully invested, you would have gotten about a 7.2% rate of return over that period. And you might say, well, wait a second, Josh, 7.2%, doesn't the stock market average about 10 over time? Yes, it does, but that's over longer periods of time. And also consider that in the late 90s, was the market high or was it low? It was really high, right? The market was really high and valuations were high. So 7.2% actually started at a fairly high point during that period. So you miss the 10 best days, you lose half your return, just the 10 best days during that 20-year period. Isn't that crazy? Over that entire period, you would have lost a lot of your returns. And of course, it goes down to the negatives when you miss the best 40 days, 50 days, 60 days. That's one of the reasons why timing the market doesn't work, because the odds of you being able to get that right, or me, or Jeremy, right? Nobody can predict the future. Arguably one of the best investors of the last 50 years is Warren Buffett, Berkshire Hathaway. Even Warren says that he's never met somebody who can time the market consistently, and he certainly can't either. In fact, one of my favorite quotes by Warren is that if the stock market was only open one day a year, that he would be perfectly happy. He could do all the trading he needed to do on that one day, and the market could just close for the rest of the year. That's really the sign of a long-term investor, is somebody who feels that convicted in what they're buying, that they don't need to be able to watch CNBC every day and jump in and out of the market. Of course, the financial media wants you to believe that that's the way to success, but as you can see here, the reality is that people who do that usually end up getting really, really bad results. Now, I mentioned volatility before, and volatility, you'll note, looking over the last chunk of time here, volatility right now is actually no more than it's been over the last 5 years or so. So you see that at the end of last year, really big volatility in Q4. Again, that was when the market dropped 20%. We had the worst Christmas Eve ever, which was really weird. As a financial advisor, that's usually the one day that the market's open that you can kind of ignore it, and not this year. The market went way down, and of course the day after Christmas it went way back up. But that being said, that's volatility, right? Now what we're talking about here, when you look at a chart by this, is not losing money, right? Because we saw the chart before that said that, oh, that long-term trend of people making money, the market's gone up. This is just tracking how much volatility or how much turbulence are people experiencing. So I think it's instructive in that, wow, you can have a market that's going up and lots of volatility. Absolutely. And that's just a mark of what it is. If you think about getting on an airplane and flying someplace, turbulence is just part of the ride. And sometimes you get on the flight and the entire thing is smooth, right? No turbulence whatsoever. That's a rare flight. And that's what we saw back in 2017, is that we had very, very low volatility, be like being on a flight across the country, no turbulence. Then in 2018, of course, things started to get turbulent, and a lot of people started getting nervous, right? Because they said, this is really weird. We haven't ever seen this before. Well, it's just because we had seen a span of time. It was kind of like being on the airplane and the whole flight is perfectly smooth, and then all of a sudden some choppy air comes up and people think, wow, this turbulence is terrible. That's just because they're not used to it, right? So that's just human nature, I think, is that we kind of get used to whatever is going on. Even volatility, right? Even volatility people can get used to. Again, like the airplane, you can get actually used to a turbulent flight. Doesn't mean we like it, right? People may not enjoy turbulence, but that's all that it is. Doesn't necessarily mean that the overall trend is people losing money. Federal Reserve, again, they've kind of gone back and forth as far as helping our confidence. So far here recently, they've actually boosted confidence, and since this slide came out, they actually have now lowered interest rates by a quarter point, and when they meet again in September, more than likely will lower again by another quarter point. So what happens when interest rates go down? And this probably is going to be a trend, right? We probably are going to see some more rate decreases. because the economy is showing some signs of slowing. I don't think a recession, but signs of slowing. And also inflation remains very, very low right now. So what happens, again, we talked about borrowing before. It's a great time to refinance a mortgage, to buy stuff and finance it. It's actually good for the government too when you think about it, because the federal government operates largely by debt, right? We issue bonds in other countries and people buy those bonds, and that's what ends up financing it. If interest rates go way up, that means that the government, which is us, right, but the government's actually paying a lot more interest, and it actually can hurt the economy. So believe me, it's not just consumers and businesses. This is actually a positive for the federal government as well. U.S. exports grow, the economy grows, jobs are created, a lot of virtuous things that end up happening. Investors are willing to take on more risk, right, because leaving the money in the bank is getting a lower rate, and so people aren't rewarded much for just letting the money sit there, and therefore they tend to go buy stuff, right? They buy stocks, bonds, real estate, other things, and those asset prices go up. Now, why would the Fed ever raise interest rates? Well, why they raise interest rates is because of fears of inflation. And for those of you who lived through the late 70s, early 80s, and I was around, but too young to even care about the markets right at that point, but it was very, very high inflation. I'm sure a lot of you remember that we had double-digit inflation. Here you can see our example of really, really bad inflation down there with Venezuela. We had 10 million% inflation, just insane, earlier this year. That would not be a good thing. We've never gotten anywhere close to any of the numbers on this sheet, but you can see many countries that are having inflation problems. How the Fed handles that is that they will raise interest rates, and that actually tightens the money supply. On my previous slide there, all those things basically just go in reverse, which you might say, well, doesn't that hurt the economy? Yes, it actually does. But the Fed can only fight one battle at once. They can only either fight the inflation battle or to try to get the economy going. That's always the debate, right? Is how much do they put on the gas versus the brake? And they've actually done a pretty good job of it over the last few decades. In the late 70s, early 80s, a lot of missteps, I think, by the previous Fed, did kind of the opposite of what they should have been doing. And when Paul Volcker, you might remember the Fed chairman at the time, took over, he was convicted that he would beat inflation. And when interest rates went through the roof, it actually brought inflation way back down. And lo and behold, the economy got going again. So it's not something that you want to let inflation get out of hand like that. It gets much uglier when that happens. And, earnings here, I want to touch on earnings before I pass it over to Jeremy. Earnings have been very good by and large last year, especially with the tax cuts that corporations got a big tax cut on their corporate income tax rate. That helped a whole bunch. Projections are still increases in earnings overall. If we look at the S&P 500, growth may not be as much as what we've been experiencing, but earnings continue to go up. What that actually does is it justifies prices where they're at right now. If you look at the long-term price to earnings ratio of the S&P 500, that's just comparing earnings and prices, right? Because we've got to look at it relative, right? If you look at the price of the market, you might say, well, it's expensive, it's cheap. Well, compared to what, right? Really, what is a company anyway? A company is basically just its profits. Now, of course, they're delivering products and services, but the earnings of the company are the only reason why anybody would invest in it. You wouldn't invest in, Coca-Cola because they own a bunch of buildings or trucks or something like that, right? It's because the product and the service they're providing generates earnings. They figured out a way to be profitable at that. And so if they're able to generate higher and higher earnings or profits, same thing, over time, that's going to generate the ability for investors to make more money, and that justifies a higher stock price. So I throw that out because the average price to earnings ratio in the market over the last, say, 80 years or so has been about 17. Right now we're sitting at about 19 or so, depending on what day you're listening to this, about 19, so just slightly above the long-term average. What that tells me, especially with low inflation and low interest rates, we're really not at very expensive valuations on the market. Certainly not the 29-30 price to earnings ratio we saw back in the late 90s. So with that, I'm going to pass it over to Mr. Busch, and he is going to talk about where we are today.
All right. Thanks, Josh. So where are we today? Well, this is a year of milestones, believe it or not. We have the 75th anniversary of D-Day, 55th anniversary of the Civil Rights Act. This is one that got me right in the childhood, not going to lie. 50th year that Sesame Street has been broadcasting. That's pretty crazy. I know 50th, this one was in the news quite a bit, Neil Armstrong landing on the moon. I'm sure many of you are excited about 20 years of listening to Ricky Martin, Living La Vida Loca. That one's a big one. And oddly enough, the 10th anniversary of Avatar, which until this year was the highest grossing film anyway, which was just this year replaced by Avengers Endgame. So random trivia there. The other big milestone, obviously, 10 years of expansion, the longest expansion in U.S. history. And so really the question is, this is another one that you'll hear in the market a lot. Says, oh my gosh, this expansion's been going for 10 years. It has to stop, right? No, we've never seen anything like this. Well, let's look at how we actually got to that 10 years. The answer is slow and steady. Really, this has been a tortoise expansion, if we really think about it. Think about the tortoise and the hare. We've seen them in the past where it spikes up very, very quickly. You get a lot of gain in a very short time. That is not this last 10 years. You can see by that graph there. It hasn't even reached 2% overall GDP, which gross domestic product basically over that time frame. It's just been very slow, very steady, some higher years than others, but really just an average push that kind of continues on over the years. This is a good spot to say, everybody's saying, again, that 10 years, holy cow, how much longer can this possibly go? I think it's important to remember that no expansion in the history of U.S. expansions has ever died from old age, okay? It always takes some kind of shock event. So when we think of shock events, we think of things like the 2008 mortgage crisis, okay, where we had a bunch of people who had mortgages that really probably shouldn't have. Mortgage companies were very free to give anybody money that they wanted to. And then a lot of companies were basically selling mortgage debts and putting them in investment vehicles. They're kind of called collateralized debt obligations that they would put them together and say, hey, buy all these people's debts. They're paying their mortgages and you're going to get the interest off this. And that wasn't the case. They were really bad vehicles. Before that, we see things like 9/11. So things that people really can't predict on the large scale, and you never really know when it's going to happen. Those typically tend to be the things that really send something into a recession, okay? So with that in mind, then, where kind of are we right now? So as Josh mentioned earlier, yes, we're seeing signs that the economy is slowing. So the economy has been very, very steady up to this point. But yes, there are a lot of indicators showing that it is slowing down. For instance, these are things you'll hear in the media. There's fewer new jobs out right now. Well, yeah, there's fewer new jobs out right now, but on the flip side of that, unemployment is at its lowest rate since 1969. Okay, so just because there's fewer new jobs doesn't mean that anybody who's employed really, or who wants to be employed, is employed. Okay, there's another indicator that's a really big one. Manufacturing has been weak. We have seen manufacturing numbers at least drop a bit. So basically saying the companies are making less. That can be very well indicative of a lot of the trade stuff that's happening between Mexico, Canada, China is a big one as well. Companies aren't going to be ramping up on their production when they foresee maybe that, we don't want to be holding on to a lot of inventory right now. It's costly to do that. It's actually just kind of a smart business move, really. Another one that's a big one, quit rate levels. So that's one where people basically have a job and they quit that job to go work for someone else. They're going to make some money elsewhere. That one is kind of leveling off at its 15-year high, they say. Again, I don't know that that's kind of a really off-the-wall one when I think about it. Just a lot of these things, but these are the things that you hear in the media that they jump all over and they say, well, this is going to do this, or this is definitely going to do that. We just got to kind of keep them really in check. And again, they're a lot more. They are indicative of things slowing down or recessions, but they're not definitive. So if we look forward, what are the kind of big issues that we're dealing with right now? Obviously, the big thing happening is tariffs and working with China. What is a tariff? Obviously, a tariff is nothing more than just a tax. All right. They say, hey, we're going to put a 10% tariff on all the goods that come in from you. I have yet to find a company that says, you know what, this government is going to charge us 10% extra, but we're just going to eat that 10% and we're just going to let you continue to buy our product at a lower rate. Okay. Unfortunately, that really doesn't happen. So obviously what happens to that is those tariffs or those extra taxes get tacked on to the prices of the goods that we buy. What does that really mean per household? If we break it down per American household, a 10% tariff on Chinese goods, really per year, that works out to about $414 extra that your typical American household would be paying. Okay. For most of us, that's probably not going to be a huge deal. That's not a big bank breaker right there. If they raise it up to 25%, that's an additional $831 per year. Again, not a super fun thing to be paying, but again, probably not going to be breaking the bank for most of us. In the long run, though, what we can see if we look at the macro effect of this, for instance, the U.S. Currently, we had first quarter was about 3.1% gross domestic product. Basically, how the economy is doing, what we're bringing in. As long as it's a positive number, we're doing fairly well. For the U.S., anywhere from 2 to 3% has been pretty good for us. So 3.1 in the first quarter, absolutely good. We definitely saw a bit of a drop off to about 2% in the second quarter. So really, if we look at that and we go back to those percentages, the 10% tariff, really what that would look like is that would say, okay, we were at 2%, but really that's going to drop that number down to, let's say, 1.8%. Okay. Or if we say it's a 25% tariff, that's going to drop it down from that 2.1% to about 1.6 now. Okay. So that's when we start to see this, but we can also, that's when we see it to start to affect things, and that really accumulates over time. So as we can see by this graph on the screen right here, this is showing projected 2021, 2022. We can take a couple things away from this, really. You can see that China line with those 10% and 25% tariffs right there, China honestly does have a little bit more to lose than the U.S. from this deal. Okay, when you look at the line on top, you can see that just by definition, the size of China's economy and the size of the U.S. economy, they're big enough to impact the overall world GDP as well. And so if this continues to kind of spiral out of control, then yes, that could definitely put the world in a bit of a negative situation. Now, as far as the likelihood of that, that's another story. According to The Economist from May 2019, really it's in everybody's best interest to get this done. Like we were saying, China has a little bit more to lose than the U.S. As far as the U.S. goes, we are seeing definitely some pullbacks as far as consumer spending, things of that nature. In China right now, I know there's a lot of economic upheaval. I mean, look at Hong Kong right now. You can see that the people themselves, the Chinese people, are really kind of starting to fight back a little bit about this and make their voices heard a little bit, which is having some other effects over there. Again, a bull market never died from old age. It takes some kind of shock event. Could this be some kind of lead up to a shock event? Potentially, but really it is in everybody's best interest to get this deal done. All right. The other thing that we want to look at, and Josh had kind of hinted at this earlier, was investor confidence. And so this is another one that's kind of one of those misleading, emotional type of things, okay? So we know that October, November, December of 2018 was a downtime, okay? And so you can see that as a result of that, in January of 2019, investor confidence was at its lowest in quite some time. However, if we look at what the market was doing in January 2019, the market had its best January since 1987 in overall gains. And so you can see January was great. February and March were also good. And so you can see that investor confidence index doesn't always match up with what's actually happening in the market. You can see October, November, and December right there, much higher than they were in January in that first quarter of 2019. But investor confidence was higher and the market was on its way down. So it's kind of a lagging indicator, not very indicative, I think, but you'll hear a lot of the media jump on this and say, well, investor confidence is at an all-time low, or blah, blah, blah. Again, one of those things you kind of got to take with a grain of salt. It's indicative of certain things, but definitely not definitive. All right, and from here.
Yeah, and the irony around that too is, again, the fact that when investor confidence is at its lowest is typically the best time to invest, right? Actually, when the market can come back very quickly during those times. I think it was Sir John Templeton years ago. He's passed away a number of years ago, but one of the most successful global investors of all time. And one of his quotes is that you want to be fearful when others are greedy and be greedy when others are fearful. And I think this illustrates it very nicely in the fact that, well, there was a lot of fear, right? After the market had sold off 20% in December, January, investors weren't feeling very good, yet the market was skyrocketing, right? It was going way up. So it's interesting that you don't necessarily want to look at a statistic and try to have that be the thing, and try to time the market based off of that, because oftentimes it can lead you exactly the opposite direction of what you should be doing. So, of course, the real answer is to plan for the long run. We'll talk about where we may be going, but when we plan for the long run, we're talking about money that's going to be spent over decades, right? For most of us, our investments are in investments because we're not going to touch them anytime soon. And even when we start touching them, they're going to be used over a long, long period of time. So, for example, somebody might say, well, I'm going to retire next year. And they might think, well, maybe I need to stick all my stuff in conservative investments. Well, if they're 65 years old, chances are they've got another 30 years to roam this earth. That's a lot of time. They need to make sure that not only that money grows to keep pace with inflation, but it also tells you that the day-to-day stuff, the China stuff, people probably won't even remember this, right? Even a couple of years from right now, we'll have moved on to some other new crisis, right? There's a few, like the financial crisis, that we'll all remember. I mean, it's going to take a long time for us to forget, but I think the reality is that most of these things come and go, and we could have gone through each one of those years. On one of my earlier slides that showed the last decade, we could have gone through, had we the time, and gone through each single one and said, well, here's what was going on this year, and you'd say, really? And the market went up? Yes. So there's all kinds of stuff coming. These are the game changers, right? Is that we've got drones and 3D printing and all kinds of bioengineering stuff that could make sure that all the diseases of the world get cured. There's all these things that are being talked about, self-driving cars. They're saying that in 2040, most people won't even own a car, right? You'll just walk out of your house and a car, it'll probably be owned by Uber, right? But a car will have picked, it already knew you were coming out. In other words, it'll be smart enough to know, oh, well, Josh is leaving. And so a car pulls up from around the neighborhood and away we go. So all kinds of interesting stuff coming. that will certainly improve our world and certainly will drive a lot of profitability for the companies that are involved in these things. Certainly Facebook and other companies, Google, a lot of scrutiny there. So keep an eye on that. One thing to note is that especially as the economy gets into the later stages, and certainly we would say we're not in the beginning stages of an economic recovery or expansion, as it gets later on in those stages, technology stocks don't necessarily always become the best performers. In fact, right now, one thing that could impact a lot of tech companies, and I know this is near and dear to many of your hearts because you worked for tech companies, or maybe you still work for a tech company, that your company may be impacted by this. Regulation may increase, and the government may get more and more involved in companies, could even break up companies, right? Some companies that they get so large, like Amazon, there may be some point where they try to break those up. So not necessarily always a rosy ride for these companies. New clean energy source, snow. I don't know if you've heard about this, but now they're experimenting with this, that actually using snow to convert that into energy. And then really what's being predicted overall is that, I think this is probably realistic, right? For the remainder of this decade, we're probably not going into a recession, at least not one that can be predicted right now. We're probably not actually going into a recession, but it could just be continued slow growth over a long period of time. Now, historically, if you look over the last 80, 90 years, the U.S. economy has grown at about 3% a year. And you can see the prediction here, and this is consistent with what we're seeing right now, right? With GDP numbers currently are sitting right about 2%, just north of, depending on whose numbers you look at, but right about that 2% mark. So certainly lower than the long run. And there's some different factors at play there, depending on which kind of economist you're listening to. There's conservative economists and liberal economists, and they have very differing arguments for why this is all playing out. But overall, the one thing to note is that there's not a prediction of a recession. And this is not just looking at rosy numbers. This is actually looking at experts like Janet Yellen, former Fed chairman, Alan Greenspan. Others have commented even on this inverted yield curve stuff and the things that are being thrown around by the financial media, that those things are not necessarily predicting a recession. Like Jeremy said, more than likely, when we have a recession, and I can most assuredly tell you that there will be a recession somewhere between now and 2029, it's going to be because of something unpredictable. It's going to be because of something that happens in the world or in this country that causes a big drop in spending. It shakes people's confidence. When people are less confident, this is different, right? There's consumer confidence numbers and investor confidence numbers. Investor confidence numbers, you don't want to pay attention to those because they'll probably lead you astray. But consumer confidence, that's a whole different story. If consumers get really, really uncertain, and of course, if unemployment rates are going up, that makes them even less certain because they're afraid they're not going to have a job. Now you've actually got overall less spending that's going on, and that really could lead to a bad trend, like we saw in the financial crisis, with people pulling way, way back on their spending. Average age of Americans is increasing, of course, and looking out to 2060, we're going to have a lot of 90, 100 plus year people running around. And the good news is that a lot of those people, not only will they be living, but they'll be very healthy with all the advances that are expected over the next decade even. It's pretty staggering, not only how much that they're going to be able to cure or prevent as far as the major diseases that we deal with today. A lot of progress being made there, but also being able to prolong people's lives and have a higher quality of life. In a lot of cases, even living in their own home for a longer period of time, maybe driving vehicles for a longer period of time. Our oldest client is 96 and he still drives, and he drives well. So I think you're going to see a lot more people like him running around as years go on. So that's a big factor, not only because that's a longer period of time for people to be able to spend money, right? As consumers, if they're healthier and running around, they're probably spending money on stuff like travel and vehicles and iPhones and whatever it is that they're buying, right? That's all the stuff that supports the economy. But people also will be working longer. The prediction is that people will be working longer, and that also has lots of good effects on the economy. Politically, we're not going to get into that a whole lot, just not a lot of change really from what we've been seeing. The Congress hasn't got a whole lot done, and they probably still will not get a whole lot done. And if you're an investor, you probably would just say that's fine. You'd say, you know what, gridlock is a good thing when it comes to the market, and history would definitely vindicate that opinion in that the market doesn't like uncertainty. The market doesn't like massive shifts on one side or the other. And so gridlock probably will continue. Right now, it's hard to tell who's going to win what election, the president and Congress. There's a lot that can change over the next year, but more than likely, we're going to move forward with a divided political situation regardless. What that tells you is that there are enough checks and balances in play that no extreme legislation will get passed on the right or the left. So really, what could screw all this up? Really, obviously, we've identified some risks, some things that the market likes and doesn't like. But at the end of the day, what could those shock events, what could those things that would throw us into a recession be? Now, if you look at history, a lot of times the things that people were even predicting on a list like this, it's something else, right? It's something that we didn't even see coming, right? But the things that we know that are out there, the black clouds that could turn into storms, Gulf tensions, well, you could have said that for the last several thousand years, right? When have there not been Gulf tensions? That's going to be the case forever, right? But there are tensions in the Gulf right now. It's just which players are involved. Certainly, Iran is probably the one that's causing the most headache for people who are worried about that stuff. Global trade tensions, of course, with China and the U.S. That's the biggest thing. But certainly, it's reshuffling a lot of cards right now in the world. If you are an employee at a big global company, I'm sure you've been impacted. I'm sure you know people involved in supply chain stuff that have had to make all kinds of changes. You're probably trying to operate with less inventory. You're trying to operate with a lot more uncertainty, right? So that's one negative effect of this is that companies aren't as certain, and so they could put off investments that they would make. It could be that they would put off decisions that they would make because they're uncertain about how the trade stuff is going to impact their company going forward. European fragmentation, that's really about Brexit, about the UK splitting off from the European Union and the implications, the unknown about that. So certainly as we get into this fall, that'll become a bigger issue. So Boris Johnson, the new prime minister, has insisted that they will be exiting the EU one way or the other, even if it's messy. And of course, messiness could certainly impact not just their market and their country, but ours as well. U.S. and China competition, of course, this is not just an economic thing, but a military thing, a political thing. You probably heard this last week. Donald Trump said that we want to buy Greenland, right? Well, that's not just because we need more real estate. It's because of, from a military standpoint, it would put the U.S. in a position to have more military bases, be positioned more strategically, and then the natural resources of Greenland. So again, it's a power play. Really, a lot of this is a power play, not necessarily because our economy needs it. It's really more of a power play to try to rebalance. And of course, China, is jockeying as well. So that's really what you're seeing with all this trade stuff is that the two countries really jockey for power. And then South Asia tensions, again, largely around China, but other countries are getting into the mix as well. And you'll like our cartoon here today on Wall Street. Yesterday's panic selling was replaced by panic buying. And it probably resonates with you, right? If you follow the market or watch the market, and I hope you don't, by the way. Hopefully you're not all sitting at home just watching the market all day, because that would be, not only would it not really do anyone any good, right, but it probably will cause a lot more stress in your life. But that's what it feels like, right? If you're watching the nightly news or see the market, it's kind of hard to ignore it, right? The reality is that the whipsaw that some of the market is doing, well, it's not just a straight down number, right? When there's losses in the market tends to roar back just as much, if not more, on the upside. So it's the volatility, it's the turbulence factor that really can get people unnerved if they watch things too closely or pay attention to too much of the financial media.
Pretty sure that was the news last week, in fact.
Exactly. Again, Christmas time, Christmas Eve, and then the 26th, I think, the day after Christmas, market went way up again. So I would probably, if I were you, I would just get used to more of the same, by the way. Even if China and the U.S. came out tomorrow and there was some grand bargain that, oh, we've got this great agreement and we're going to eliminate all of our tariffs and we're not going to do any more tariffs. That's not the end of it. We all know better than that, right? That this is something that's going to play out over a number of years. Certainly something that's not going to get resolved anytime soon. So more of the same, basically. Just expect more of the same. Will it impact the market? Yes. Will the market start to get used to the stuff going on with the trade and the back and forth? Yes. Everybody will kind of get used to it and move on. So the prediction as far as economic growth, this is the world economy, not the U.S. economy, but the forecast is 2.6% growth over the next year. And you can see here that from two different quotes, they both agree on the same thing, even though the World Bank and IMF say one says good, stronger than expected, one says weaker than expected, and they both say 2.6%. So I think it was Harry Truman that said he wished that there was one-handed economist. He wished that his economists that were telling him what to do just had one hand, right? Because economists say, well, on the one hand, this, and the other hand, this. So that's probably what it feels like to listen to the presentation here, right? Because there's a lot of data out there, some of it good, some of it bad. But in the end, I think most people agree that we're probably not headed towards a recession right now. But we're probably not going to see skyrocketing growth either. We're probably in for continued slow growth going forward. And for a lot of people, they're perfectly okay with that. Jamie Dimon, who's the CEO of Chase, which is one of the biggest banks in the world, certainly somebody worth listening to. He was one of several people that was involved in the fall of 2008 with basically trying to keep the system from collapsing. And of course, there were a lot of forced marriages among financial institutions that needed bailouts and all that. So an ugly time period. But Jamie Dimon actually was one of the shining stars, I think, as far as helping things stabilize. But he said CEO plans for hiring and capital investment remains healthy, but uncertainty about U.S. trade policy, softening global growth conditions, and inaction on other pressing public policy issues are a concern. And I agree with that wholeheartedly. I think Jeremy does too, that there's a lot of uncertainty out there. Everything is not perfectly rosy, but overall, the consumer is healthy right now. The unemployment picture is very, very good. And looking at those stats, other than a big shock event, it's just really unlikely that we're going to see a recession that hits any time in the near future. So that's really good news, I think, for people that are worried about some of the headlines and things and asking, gosh, are we headed towards a recession? We could be with a shock event. But if it's just the normal course of things, it probably is going to be some time until we actually would go negative.
Yeah, and just to kind of jump on top of that too, like Josh is saying, when you look at individual indicators, yes, those are the things that the media likes to throw out to kind of scare you. But when you look at the overall picture, a number of things looking together, employment, earnings growth from companies, et cetera, it's still looking pretty good. Not everything is rosy, obviously, but it's still showing good growth, good potential for the future. But as always, we know that eventually, as every cycle does, there has to be a recession sometime in the future. If we could predict that, that would be fantastic. But I don't know about you, Josh, but my crystal ball was broken last time I checked.
Yeah, it is for me too.
Yeah.
Yeah. But, I did piggyback, and Mark kind of queued me up here. He said, that's why we hire you. And that is the truth, really. And that's kind of the point of the slide here at the end is, we certainly do look at the past. We always want to look at stats and certainly really wise people like Warren Buffett and others, but even he doesn't know what's going to happen in the future, right? Some of the issues that are coming up are newer issues or things that are uncharted territory. That may be what it feels like. More than anything, though, we just want to control what we can control. And the primary thing there is just being focused on your goals, your planning, and overall diversification can never hurt you. It can only help you. So having a well-diversified portfolio that really is well thought out, with your input, of course, but really that's what we're doing when we're allocating portfolios is staying very, very diversified of course, and making sure that it's tailored to what it is that you need. And making sure that we're not putting you on an airplane ride that you're not up for, right? I think it was John Madden. John Madden doesn't fly, right? He's not on TV anymore, but he famously drove his RV from city to city for the football broadcasting that he did. So he just didn't fly. He wasn't an airplane guy, and he knew it. That's great, right? And that would be akin to a really, really conservative investor. We know we've got really conservative investors all the way up to very aggressive investors. That's why we're here to help make sure that you're positioned correctly. So with that being said, we're right at the top of the hour right now, but any questions that you've got, I don't see any in the queue right now. So either that means that you haven't thought of them yet and you'll ask them here in just a second, or Jeremy and I did such a wonderful job that we answered every question that was on your mind.
I think it must have been the second part there.
It could have been. It could have
Absolutely.
been. So I know some of you have to pop off, but we will wait here for a few minutes just to cover a couple of things. For those of you who are in town, by the way, we do have a couple of events coming up. We do a lot of webinars, but we do stuff here face-to-face as well. We've got Jamie Hopkins coming in next week and talking about taxes and retirement. And we may be able to get him on for a webinar at some point as well. So definitely stay tuned for that. We've also got our client appreciation coming up here at Chipungu Sculpture Park here at Centera Mall. So for those of you who are in the area, we definitely want to open that up to you to bring your family, and we're going to do some family photos and have fun that day. Always want to just say thank you for your business. We couldn't do what we do. Certainly, Jeremy and I wouldn't have jobs, and that would be sad because not only would we need to go do something else, right? But I think it's also just a really great career that we're able to have because we get to help people in such a tangible way with your retirement plans, your financial plans, things that impact not just you, but also additional generations, possibly kids, grandkids, other organizations that you might support. So really that's the whole point behind all of this is not the granular stuff as far as GDP in the market and everything. That's important. But really what we're more focused on is your life and how all of this impacts you.
Absolutely. And and to reiterate, Josh was talking about the upcoming events, and even if you do live out of town, we do try to put as much stuff on webinars as we can. Technology growing, we're doing our best to keep up with all of that and trying to put as many things on there. Even things like client appreciation event. If you do live out of town, you probably will still get those invites just because we don't know your travel schedule or your plans or anything like that. So we're just going to err on the side of we want to make sure that you know you're always invited on the off chance that maybe you'll be in town. But we look forward to seeing everybody there, as many as we can.
Very good. I don't see any questions in the queue right now, so I'll kind of wind it down. But again, I do want to say thank you to all of you. You probably had other stuff you could have done for the last hour. So certainly hope this was of great value. That's really what we're trying to do more than anything is make sure that whatever we're delivering, whether it's investment advice, financial planning advice, or it's really just educating you on stuff like this, we want to make sure that it's of high value. So thanks for your business, of course. Thanks for your time today. And as always, if we can do anything to help you or help a family member, friend, certainly point them our way, and we will take great care of them. Take care. Have a wonderful weekend, and we'll talk to you soon.